What's up, everybody? Welcome back to Personal Finance with Carr. Today, we're diving deep into a topic that can save you thousands of dollars. I'm talking about legal tax hacks for 2025. We'll break down each strategy step by step, so you can understand exactly how it works and if it's right for your situation. So, grab a notepad, buckle up, and let's get started. First up, we're tackling retirement contributions. We're talking about two powerful accounts here, 401ks and IRAs. With a 401k, you're contributing pre-tax dollars, which means you're lowering your taxable income right off the bat. Plus, many employers offer matching contributions, which is essentially free money. Then there's the IRA, or Individual Retirement Account. For 2024, the contribution limit for 401ks is $22,500, and for IRAs, it's $6,500. So take advantage of these accounts and watch your retirement savings soar. Next up, let's talk about a powerful tool for saving on healthcare costs, the Health Savings Account, or HSA. Now, HSAs are only available if you have a high deductible health plan, but if you do, they offer some incredible tax advantages. You contribute pre-tax dollars, just like a 401k, which lowers your taxable income. Then you can use those funds tax-free to pay for eligible medical expenses like doctor visits, prescriptions, and even some over-the-counter medications. But here's the kicker. Unlike a flexible spending account, FSA, the money in your HSA rolls over year after year. For 2024, the contribution limit for an individual is $3,850 and $7,750 for a family. So if you're eligible, consider taking advantage of this powerful savings tool. All right, let's talk about education, specifically how you can save money on college expenses with valuable tax credits. First up, we have the American Opportunity Tax Credit, or AOTC. This credit can offset up to $2,500 per student per year for the first 4 years of qualified higher education expenses. Then there's the Lifetime Learning Credit, or LLC. You can claim up to $2,000 per tax return for qualified education expenses. If you qualify, they can significantly reduce your tax burden and make education more affordable. Now, let's talk about a deduction that's become increasingly popular in the age of remote work, the home office deduction. If you're self-employed or work from home for a portion of your job, you might be able to write off a portion of your home expenses. Here's the deal. To qualify, you need a dedicated space in your home that's used exclusively for work. Once you've established your dedicated workspace, you can deduct a portion of your rent or mortgage interest, property taxes, utilities, and even homeowners or renters insurance. The simplified method is easier, but the regular method might result in a larger deduction, especially if you have a large home office. Just make sure you keep accurate records of your expenses, like receipts and invoices, in case you're ever audited. The home office deduction can be a great way to offset some of the costs of working from home and reduce your tax liability. Let's talk about giving back to causes you care about while also potentially reducing your tax bill. To qualify for this deduction, your donations must be made to qualified charitable organizations. You can find out if an organization is eligible by checking the IRS website or using the IRS's tax-exempt organization search tool. When it comes to deducting your contributions, you have two options. You can either itemize your deductions or take the standard deduction. If you choose to itemize, you'll need to keep detailed records of your donations, including receipts, bank statements, or even written acknowledgments from the charities. This is crucial if you're ever audited by the IRS. By understanding the rules and regulations surrounding charitable contributions, you can potentially maximize your impact and reduce your tax liability at the same time. Remember, giving back to your community and supporting causes you believe in is a rewarding experience in itself. Now, let's dive into a more advanced strategy that can help you offset capital gains and potentially lower your tax bill tax loss harvesting. Essentially, tax loss harvesting involves selling investments that have lost value to offset capital gains you've realized from selling other investments at a profit. By offsetting those gains, you can reduce your overall capital gains tax liability. Here's how it works. Let's say you sold some stocks earlier this year and made a profit of $10,000. You also have some other stocks in your portfolio that have lost $5,000 in value. With tax loss harvesting, you could sell those losing stocks to realize the loss. You can then use that $5,000 loss to offset your $10,000 gain, reducing your taxable capital gains to $5,000. This can result in significant tax savings, especially if you're in a high tax bracket. Now, it's important to note that you can't simply buy back the same or a substantially identical security within 30 days of selling it at a loss. Tax loss harvesting can be a complex strategy, so it's essential to consult with a financial advisor or tax professional to determine if it's right for your situation. Now, let's talk about a valuable tax credit designed to help low to moderate income working individuals and families, the Earned Income Tax Credit, or EITC. The EITC is a refundable credit, which means that it can reduce your tax liability to zero and even result in a refund, even if you didn't owe any taxes. The amount of the credit you can receive depends on your income, filing status, and the number of qualifying children you have. To claim the EITC, you'll need to file a tax return, even if you're not otherwise required to file. The EITC can provide a much-needed financial boost for eligible individuals and families, so it's important to be aware of this credit and see if you qualify. Alright, let's talk about a deduction that can help you save money on your student loans, the student loan interest deduction. If you're paying off student loans, you might be able to deduct up to $2,500 in interest paid on those loans each year. This deduction is available even if you don't itemize your deductions, which means you can claim it even if you take the standard deduction. The loans must also be for you, your spouse, or your dependent. The student loan interest deduction can provide valuable tax relief for those struggling to repay their student loans, so it's important to be aware of this deduction and see if you qualify. Now let's talk about flexible spending accounts, or FSAs, which are employer-sponsored plans that allow you to set aside pre-tax dollars for eligible healthcare and dependent care expenses. There are two main types of FSAs, healthcare FSAs and dependent care FSAs. With a healthcare FSA, you can contribute pre-tax dollars to pay for eligible medical expenses, such as deductibles, co-payments, and prescriptions. Dependent care FSAs, on the other hand, allow you to contribute pre-tax dollars to pay for eligible dependent care expenses, such as daycare, preschool, and summer camp. The main advantage of using an FSA is that the contributions are made pre-tax, which lowers your taxable income and can result in significant tax savings. However, it's important to note that FSAs are use-it-or-lose-it plans. Finally, let's talk about how you can save money on your taxes while also making your home more energy efficient. The federal government offers a number of tax credits for homeowners who make energy-efficient upgrades to their homes. For example, you can claim a tax credit for installing solar panels, wind turbines, geothermal heat pumps, and energy-efficient windows, doors, and insulation. The amount of the credit varies depending on the specific improvement you make, but it can be substantial. In addition to federal tax credits, many states and local utilities also offer their own incentives for energy-efficient home improvements. Making your home more energy efficient can not only save you money on your taxes, but it can also lower your energy bills and reduce your carbon footprint. There you have it, guys. 10 powerful tax hacks to help you save thousands of dollars in 2024. By planning ahead and taking advantage of these legal deductions, credits, and strategies, you can keep more of your hard-earned money and achieve your financial goals faster. Until next time, stay informed, stay invested, and take control of your financial future. Thank you for watching. If this video helped you take control of your finances, smash the like button to support the channel, subscribe for more life-changing money tips, and drop a comment below.